Today we'll be discussing the role of diversification, often said to be the only free lunch in portfolio management. The term was made popular in the 1950s by Harry Markowitz, a Nobel Prize-winning economist. So it'll be interesting to see and hear whether it still holds true today. So joining me today to discuss the role of diversification in portfolio management, at the far end, Andrew McKie, CIO of Elston Asset Management, Jody Fitzgerald in the middle, Head of Institutional Portfolio Management and Solutions at Morningstar Investment Management, and Mathew Jeremy, Director of Quilla Consulting. So firstly, welcome and thank you for your time.
Thanks, Jason.
So let's set the scene. We're coming to the end of 2019, a period which has seen equity markets reach new highs, fixed interest markets reach new lows in terms of yields. Markets are continuing to be heavily influenced by geopolitical risks such as Brexit and the US-China trade wars. And it seems that central bank intervention is playing a leading role in terms of influencing and being a key driver of asset returns and risk. So while diversification seems a no-brainer in a period of relatively high uncertainty, the type of diversification seems increasingly important at this point in the cycle. So let's hear from our experts. So we're hearing a lot about being in the latter stages of the current investment cycle, which infers that we may be coming towards the end of the existing bull market. Now I'd like to hear your views in terms of whether you agree with this view or whether you can see a continuation of the existing cycle. So if we start with Andrew. Yep.
It depends on the bull market whether you look at equities or bonds, or long duration bonds. But if we look at equities for a start, that camp that no, that's not the case. Although you still need to be cautious if you look at valuations or pockets of valuation in terms of equities. If you look at the global slowdown in terms of earnings, look at margins in the US at very high levels, so how sustainable that is, and also a use of leverage for buybacks in the US particularly. So I think we're not overly cautious. I think you need to be aware of those primary issues, but liquidity, interest rates, if you look at relative valuations between, say, earnings yield and bond yields, it's still reasonably attractive from an equities point of view in our view.
Okay. Jody, similar views or?
Some dispersion there in the views, which is what makes a market, right?
Well,
so, look, we definitely feel we are in the later stages of the market cycle. We've got most assets are overvalued, whether it is in the bond or in the equity space. There's certainly pockets of relative value, though, and I'll come back to that. But when you have a look at it from a fundamental perspective, the economy is showing signs of slowing down. PMIs, even though they're usually a leading indicator, they've stabilised, but they're certainly in contractionary territory. Trade has definitely slowed down quite markedly, where last quarter on the year-on-year basis, trade had slowed by 0.3%. And you've also then got the impact that the uncertainty around trade wars and Brexit is actually having on business sentiment and business investment. And without business investment, that obviously can sort of cause a slowdown. So whether we go into a recession, a technical recession, or whether we actually just see a marked economic slowdown, because of the way markets have actually fundamentally behaved, being priced for perfection, trading well above their fair values, we're not going to need to see a deep or extended recession for there to be a domino effect in markets. So we think it's really, really important to sort of understand that we don't need another GFC style event to see sustained losses within markets. So where your position will be absolutely critical going forward.
Great. And Mathew?
Jason, we're working with two scenarios at the moment. Our base case scenario has the bull market ending with a whimper, and the other scenario has it ending with a bang. So the first scenario, we see global growth being relatively muted around trend out to the end of next year. The slowdown that we saw starting late last year has rolled on. We don't think there's been enough proactive stimulus from either the US, from the Fed, or in China from the authorities over there to start pushing the global economy onto a higher trajectory. Resolution of the trade dispute will help, but it's not going to be enough. And so when you look at the outlook for growth, there's just not enough momentum in the economies to generate improvements, sufficient improvements in cash flows to flow into corporate cash flows, flow through into earnings, and profit growth in the markets that way. Then if you have a look at the valuations, Well, as we've been saying, equity markets have had a great time over the past 12 months, and so they're not sitting at the cheap end of the spectrum anymore.
Yep.
So the valuations don't look like they've got a room to move, a lot more room to move. Further interest rate reductions to try and support those valuations don't look like they've got a little more room to move. And then you haven't got a whole lot on the earnings growth. So our base case has very muted expected returns on all the asset classes. And by muted, I'm talking around 4-5% plus or minus a bit here or there, which is very, very low. Now, that's the base case. The other case is that we're increasingly concerned by some of the indicators we're seeing out of the States. Recession hasn't been our core scenario for a while, but we can't ignore the risk of it. And some of the indicators we're looking at out of the States are starting to concern us that that's something that may well tip into play in the coming year. Sort of more significant downdrafts that you get in equity markets that Jody was just alluding to, that then happens.
Yep. So I'm hearing a bit of a disconnect between market pricing and the economic sort of fundamentals of the various regions.
I think it depends on, in equity markets too, where you're looking at. There has been a flight with risk off to more certainty. So if you look at business valuations and businesses that are, say, have less complexity or don't have business growth that's contingent on GDP growth, they've been bid up to be quite expensive. So whereas there's pockets of valuation outside of that. So anything that perhaps cyclical growth or has challenges in terms of complexity, there's actually reasonable valuation there. So there's a bit of discussion which is pretty active at the moment around growth versus value, and I think that's why that's playing into that debate, is that people have been looking for certainty but willing to pay up for that certainty, but outside of that there's value. So I think it's also hard to just make a broad brush assumption around markets. That really you need to look down within that as to where valuations are.
So, something to add, you alluded to this a moment ago about the geopolitics. We think that is probably going to be increasingly challenging for markets in the coming year, and particularly developments in the political cycle in the States, and with the primaries for the Democratic nomination. We could well see some surprises there as to who gets the Guernsey to run, and somebody with policies that the equity markets really don't like. And that can create some turbulence too.
Okay, so at a portfolio level, so thinking about those challenges and the challenges that sort of lay ahead into 2020 and beyond, how are you positioning portfolios? So thinking about fixed interest in terms of its role in the portfolio, given the lower for longer sort of rate expectations, equity markets, given their valuations, and again the economic fundamentals, and the role of alternative assets in portfolios as well. So maybe start with Jody.
Yeah, sure. So maybe give you some context about the way we manage portfolios. We're a relative value manager. We seek total return outcomes. So we manage risk according to drawdown risk. We're worried about losing money. We're not worried about tracking error or some notional benchmark. We manage to a CPI plus objective. And I agree with you, those CPI plus returns are going to be harder to actually achieve going forward. So from that perspective, obviously, we're then sort of tilting our portfolios in the areas that we do see relative value. So, going forward, as I suggested, we do see lower returns. However, the dispersion of returns in equity markets will actually be quite wide. So the areas that we quite like at the moment are Europe, particularly European financials, European energy. We actually like UK, even with a Brexit scenario priced, no-deal Brexit scenario priced in, which is looking like it's reducing in probability. South Korea is also an area that we're sort of loading up in the portfolios, and as well as Japan. So what we don't like is the US. So in our, what we would refer to as our growth portfolio, so a diversified sort of 70-30 type portfolio, we only have 5% US equities. And the vast majority of that will sit in more defensive sectors such as consumer staples and healthcare. We only have 5% Australian. So they're markets that we're largely out of because the valuation risk is way too high for the risk for the reward. Fixed income is an interesting one because we're in an environment of low interest rates and in some cases negative interest rates. So we've seen negative interest rates in Europe since 2014 and in Japan since 2016. What that does is it actually diminishes the diversification role that fixed income actually plays in a portfolio. So from our perspective, we still think you should hold some fixed income, but it's important where you hold it on the curve.
Sure.
So we have a focus for short duration within the portfolios. But if you accept that the diversification role of fixed income is certainly reduced in this environment, you've got two options. Accept lower returns because you've got that less of a free lunch associated with the diversification, or look for alternative sources of diversification. And that's where the alternatives that you mentioned before really come into play. So we certainly play a role in the portfolio, and our alternatives exposure consists of your standard macro type portfolios, but also commodities, MLPs, which are energy infrastructure, particularly out of the States, and various sort of FX trades that can provide you with lower volatilities and lower correlated returns to equities and bonds.
And Matthew, any sort of clues on how you're positioning for the period?
Sure. Well, I think we all agree diversification is always going to be important. And Jody's right, it depends on what type of diversification you do. Look, as far as fixed income is concerned, when you look at the spectrum of fixed income opportunities, we're not keen about the top and the bottom, what I call the top and the bottom ends of that spectrum. So the bottom end is the cash-enhanced, short duration, low return fixed income. It's just not going to contribute. I mean, it's really small returns. It's not going to contribute very much. So we think we can do more useful things with the money than that. The top end of the spectrum, things like high yield, it's too much like equity. We want risk, we lose equity risk, so we leave that out. But we can see some useful roles for things in the middle of the fixed income spectrum. So notwithstanding the fact that, bond yields, sovereign bond yields are very low, we still see scope for sovereign bonds with some duration to play a role in the portfolio for diversification and hedging of equity risk, particularly like the US and Australia in that context, much more so than, say, Europe or Japan for obvious reasons. Because we think that if the worst case scenario comes to pass, then the Fed's going to cut a great deal more than they already have.
Yeah.
So there's that. Yeah. Pardon me. The other thing we like in the fixed income space is selected credit strategies. Now, credit's also an area that's become quite expensive, but there are some strategies out there which we've been using for a while, which allows some access to relative value, but also some strategies that very carefully hedge the market risk and still deliver good returns. So we use that. We're reducing our exposure to equities at the moment, partly because the expected returns have just shrunk, and as the expected return spectrum has shrunk, all the returns start to look a bit more similar. So naturally, you think, let's start broadening out the portfolio. Now, within equities, the Australian equity markets stand out a bit simply because of the income. To get something like around 4.5% income is a nice starting point, and then a bit of capital growth on top of that, perhaps. But we're reducing our equity exposures gradually at stages. Alternatives is a mixed bag. It's one of those things, we'd all like it to work, we'd all really want to use it, and we've all had experiences, good and bad, with alternatives over the years. At the moment, we are out of all Aussie equity-based alternative strategies. Long shorts, market neutrals, it's just not working there. So we're not using that. We're not using absolute funds, none of that sort of thing. What we are using at the moment is a couple of multi-strategy funds, which have low correlation to equity market direction, and we've got a bit of judicious use of gold, an old ETF, and from time to time we've used a US dollar ETF as well. So the spectrum of what we're using in that space has become very much more focused and much more tactical.
Andrew, any?
So I think from alternatives, obviously it's a broad area as well. Our view is always from investment philosophies primarily around liquidity. So we actually don't have an exposure to alternatives for that reason. Now that's not to say that you can't get liquid exposure. Looking at long short as an example, managed futures as an example. But generally we're cautious in that area, depending on the client or the advisor's time frames. We really think that time frames around liquidity for alternatives, particularly private markets, need to be sort of 10 years plus. So we don't have an active exposure in there. In terms of fixed income, we are probably similar in terms of cautious around duration. If we wind back the clock 2 years ago, we were talking about synchronised global growth, and now we're talking about synchronised global downturn. What's changed in the interim has been the trade war.
Yep.
So any resolution there, you could see some risk on. And if we look at duration, look at what's happened to bond yields, if we look at the index here, duration has now gone out to 5.7, so the sensitivity to interest rates has increased significantly. We're coming off a fairly low base, so you don't have that yield to protect you from an overall total return. So we think from here it's very challenging to generate a positive return in duration in fixed income. So we would much rather have the liquidity, we'd much rather have that defensive side of the exposure, shorter end, and as much as we're giving up some return there, we'd rather take the risk in the portfolio in the equity side.
Right.
Probably should add in our portfolios, which I didn't mention, is that we're actually holding a lot of cash. Dry powder, as we called it, so that when the markets do start selling off, we start seeing valuation opportunities we can go in quite quickly. So we're holding circa 25% cash, depending on the type of portfolio you're looking at.
Sure. Yep.
But that's kind of a pretty average holding for us at the moment.
Okay.
We'll be doing something similar, but not to that level.
Yeah, well, that's because we're total return, we're not benchmark relatively. It gives us more flexibility.
Okay.
Yeah.
Yep. Okay, so thinking through the risks and the opportunities in the period ahead, what are the two things that you think advisors should be thinking about heading into 2020? Starting with Matthew.
Sure, thanks. Look, this lower for longer, it's not just interest rates, it's everything. Everything, growth, inflation, interest rates, returns on assets, it's all going to be lower, and it's going to be longer for people than people expect. It's not just 2020. So I think one of the key questions, and we're grappling with this question now, and it's behind some of the research we're doing, the change we're making in the portfolios. The questions, because we're like you, we're running CPI plus total return portfolios. And so, okay, so that's the opportunity set, and that's what I'm trying to do. How do I fit that and that together? And so there's the first question. In an environment like this low return world going on for a while, are your portfolios, as they're currently structured, going to deliver the objectives that your clients expect? That's question number one. The second question is, if the worst does come, I'm just looking at 2020, if the worst does come to pass, and we do get a significant downturn in the US economy or the US equity market, then what's the impact on your portfolios going to be? The level of risk that you've got there, is that going to be too much in a circumstance like that? In which case, should you be thinking about doing something about that?
Okay. Andrew?
Look, I think advisors are under a fair bit of pressure. In a low interest rate, low inflation world, when you're dealing with opt-in and FDS and fee disclosures, really demonstrating value for advisors is really critical. So I'd think the two primary factors there would be around income generation, and particularly for their clients, depending on their client demographic. But if you're talking about client goals, clearly, given the current interest rate environment in Australia, there's a lot of pressure on advisors to deliver from a cash flow point of view or income point of view. So Matthew mentioned Australian equities in terms of yield. So you're trying to get as close to possible to some income objective of the client is going to be a challenge for advisors. I think in that context as well, we're very much an after-tax return manager. So I think managing tax is going to be very critical. If you think of alpha generation from an after-tax point of view, so if you can deliver perhaps 50 basis points, 100 basis points in terms of tax efficiency, whether it be on the capital loss side of things or franking credit side of things, that can really add to total return for advisors and make their life a lot easier in terms of justifying that value equation when they sit down with them. Sure. So I don't envy advisors at all. It's not easy for asset allocators. It's certainly not easy for advisors either. $7,500 per million in a term deposit in Australia now, very challenging for people self-funded looking to retire, those sorts of things. So, I think they're probably the primary. If I was thinking as an advisor, how do I demonstrate value, and what are my key objectives for some of the clients at the moment? Probably their key concern would be about income generation.
I guess from our perspective, we think what you don't own will really impact your ability to generate wealth going forward. I take your point about sort of yield seeking, but our concern with that is that people are taking on way too much risk. So going for the high yielding number, and they're not thinking about the valuation risk associated with with those particular assets. So, and the reason why what you don't own will be important is that people forget about the power of negative compounding. If the market falls out of bed by 50% tomorrow, you have to make 100% to get back to square. So if you don't fall as much in a down market, you compound from a higher base going forward. So that is absolutely critical. So if you were to sit into a portfolio management meeting in our business, the risk you would hear us talk about is drawdown risk. What's the probability of losing money? Now that's actually the same risk most advisors' clients would talk about. Risk to them is losing money. So we think out of assets that are clearly overvalued will be absolutely critical. At the end of the day, an asset is simply worth the cash flows it can generate and the growth of those cash flows. Fundamentally, if it is overvalued, it will at some point price correct. So the yield, understanding what yield you can get, but then also the valuation risk is absolutely critical. Hence why we've got some big positions in the portfolio of being underweight certain areas. The other thing that I would say is that, what's probably really critical is getting your clients comfortable with the idea that returns going forward are going to be muted. So it's about adjusting their expectations. And I think when markets are strong, we fall into the trap of saying, oh, we returned 20%. But what does that mean to a client? We should be talking to our clients about your goal is this level of wealth generation, and this is where we're currently at. Are we on track? And do we need to make some adjustments to that wealth generation goal? So focusing on the generation of the wealth rather than the absolute number, because CPI plus objectives will be difficult. If you are a benchmark relative capability, then they're going to be even more difficult because you'll get caught up in some of the negative performance that will come through.
There's an interesting subtext to what you've both been just saying, and that is a key part of what the central banks are doing with cutting interest rates. They're trying to push people up the risk spectrum.
Absolutely.
That's what it's all about. And they might be focusing on firms and investment, but it flows through to everything because the system's connected. And so, you look at what we're trying to do, similar or different ways, but we're trying to do what our advisor clients are trying to do. And when they see the cash rate shrinking below 1%, they're still looking for something. I mean, are they being forced naturally up the risk spectrum? Potentially. But is that the right thing to do? Not necessarily. And, we're on the same page about that. It's not necessarily the right thing to do. Which means then, yes, you do have to look elsewhere, and that leads to, diversification is a bit different to what it used to be. But you need to, people like us and advice, when you think very laterally about the problem, start thinking outside the box and look at some things that you might not otherwise have considered, and some of them you'll like, some of them you won't. But it's a real task for the research objective. It really is.
Yeah, you're right. I mean, people forget about, at the end of the day, going back to the comment I made earlier, an asset's worth its cash flows and the growth of those cash flows discounted. The global risk-free rate is the US 10-year Treasury yield, which has been rigged, for a better word, expression, for the last 10 years. It's been artificially kept low by excess liquidity and by the actions of the central banks. When that risk-free rate reprices, every asset will reprice off it.
I think that's our concern, is this global suppression of interest rates has distorted all asset values.
Absolutely.
So, arguably. So going back to the original presentation today, is it a free lunch in the sense that are all asset classes to some degree correlated in this environment, given that the risk-free rate has been deliberately suppressed? Matthew's saying about pushing people out, the risk curve, that's very true. But it means also those, everywhere along that risk curve, there is some degree of high correlation. You're still coming off one thematic, which is low interest rates. So I think that and even with alternatives, ultimately using unlisted or alternative assets doesn't change the risk factors that are driving those, underpinning those, whether that be equity risk, whether that be credit risk, whether that be duration risk. The underlying assets themselves are still the same. So you could argue, and this is, I think, the biggest challenge for asset allocators, is are all asset classes to some degree correlated? And when will you see that play out? So you don't get the normal negative correlations, say, between bonds and equities.
Sure. First, just on your last point about correlations and so on. One of the key things that we're looking for is alphas, investment manager skill, which is inherently uncorrelated. We're trying to find that across all the asset classes where we can, including some of the alternatives. And so in that sense, there's part of the pie that's not correlated to these factors. Now, the other thing is this notion that, and a very valid question, if the 10-year bond yield goes up, how much does it take to sort of bring the house of cards down. We don't see that as the thing that brings the house of cards down, whether it comes from the growth side of the economy. But we don't see bond yields backing up anywhere in the world significantly for a very long time. So what we're seeing now, I mean, is a major structural change down in the pace of growth, inflation, and the structure of interest rates around the world for years to come. So the notion of getting back to a 4% 10-year bond yield here or the States, we just can't see it happening. And so, you know, that, as I said, that is the threat to the valuation of risk assets. Doesn't concern us as much.
I think in the short term, I don't think that's an issue too. I don't agree with that. You know, we're in a structurally lower inflationary environment. I think that's a very valid argument. It's just coming off in the short term off a very low base. If you look at where the 10-year in Australia's come off 0.85, you know, from 2.75 in just 12 months. So, you know, coming off here is a large percentage movement in terms of the capital value of the bond, and then corresponding implications in terms of equity valuations. So I think in the short term, that's where we would be concerned. I think we agree with Matthew in the longer term that there's an argument that inflationary structures will remain reasonably low, and therefore you probably won't see the interest rates at previous levels that we used to. But in the short term, that could be where market dislocation.
And we saw it play out in the December quarter of last year. We saw a 20% drop in equity markets, and bond yields had just backed up to only 2.2. So you don't need a huge change for that repricing, because everything's priced to perfection. And you've got, you know, the zombie companies, I'm not sure who coined that phrase, but we'll run with it. You know, companies out there that are unprofitable, that are able to keep operating in this market because capital is not being efficiently allocated because of low interest rates. So once that price to perfection starts to sort of crumble, you start to see a concern about the earnings profiles going forward, you'll see some revaluations. But, you know, going to your point, will it be a broad-based market sell-off? Probably not. The areas that are hugely overvalued will sell off, hence why we're saying it's really important to take advantage of the dispersion in valuations within markets at the moment. So being passive in index, dangerous place to be.